So you gotta realize, oh, because it's not, there's nothing to buy back, right?
Would that be like a call option? When a company doesn't?
No, because, so a stock buyback is you're buying back the stock you have outstanding. This is just profit that your current stockholders would receive as dividends, but rather than getting them as dividends, you're just holding on to the money and growing. Okay, you're reinvesting it.
Yeah.
So think about it. Do you think your common stockholders would want a greater return on that money that you did not distribute out and are using to grow the company?
Well, yeah, because you're not getting the.
They're not getting dividend. Think of it, if you were a stockholder, you could have received that dividend and bought another stock in another company and earned a rate. You could have bought bonds in another company and earned a rate. So of course they're going to expect a greater return on any reinvested earnings by the company that their owners in. So again, the question is, why is there a cost for reinvested earnings? So again, earnings can be reinvested or they can be paid out as dividends. Okay? If they were paid out as dividends, investors could just use those dividends and that cash to buy other securities and earn a return. But the corporation decided to reinvest it and not pay it out as dividends. So of course you're going to be like, okay, put me in the same place I could have been had you distributed as dividends, right? So if think about it like an opportunity cost. There's an opportunity cost if earnings are reinvested, because again, stockholders could have received a dividend and put it to work for them and earn a rate of return on another investment. So that's why there is a cost of reinvested earnings from the corporation standpoint. They know that stockholders anticipate a return on any money that was not distributed to them that should have been distributed as dividends. Okay? So again, the firm should earn on the reinvested earnings as at least as much as in stockholders could earn on alternative investments of the equivalent risk. Okay? So let's talk about a little more. So again, opportunity cost is the return that stockholders could earn on alternative investments of equal risk, right? So the opportunity cost in this case would be, okay, as a stockholder, I did not receive a dividend, so I could not reinvest that money and buy another asset that could give me a rate of return. So that's the opportunity cost. Okay? They could have used that money to buy similar stocks, earn a rate of return, or the company could have repurchased its own stock and earn a rate of return. Okay? So rate of return is the cost of invested earnings and it's the cost of common equity. Okay? Think about it from an investor standpoint. If the company cannot earn at least that required rate of return on the stock, on its reinvested earnings, then it should just pass those earnings to the stockholders as dividends, because stockholders would have been happier that way. Meaning, stockholders will want at least the rate of return that they have on their stock, at least on the reinvested earnings, because otherwise, what's the point? They could have just received the cash and bought more stock. Does that make sense?
Mm-hmm.
Okay, so it should. If a company cannot earn at least the required return on their reinvested earnings, then it should pass those earnings on to the stockholders as dividends and let them invest the money themselves in assets that do yield that required rate of return. Okay? So let's talk about the two primary ways to estimate the cost of equity. Okay? Do you remember the capital asset pricing model formula?
Not at all.
Sabrina, you remember?
Oh, no, those formula, I don't remember those
No?
formula.
Okay.
When I do it over,
All right.
yes.
So, do you remember when we talked about the risk-free rate?
Yeah.
What is that?
It was like a math to it. It was like the risk-free rate divided by the, what was it, the WACC? Was that it?
Yeah, that was actually a formula, but just let's forget about the formula that the risk-free rate plays into. Let's talk about just the risk-free rate itself.
Yeah.
What does that rate represent?
Hold on. It's like I think it's like the more when you get something at a certain price, or when because it had to do with like the bonds too, right?
Yes, very good.
Yeah. So when you get the bond at a certain price, when you get it like I think what is it called, like per something per at a certain point. I'm not good at explaining
No,
this.
but so risk-free rate is basically the most secure security that you can get and what rate of return you can get on that security. So for example, remember we said the more secure or more safe an investment is, the lower rate that you can anticipate, right? Because it's safe, right? So risk-free rate is basically the rate that a treasury security would earn, right? Remember we said the lowest rate you expect on a treasury security is issued by the government, then it's followed by AAA, then it's followed by AA, and then triple B junk bonds. So risk-free rate is the rate of return on the most secure security, which is issued by the government, okay? So when you're talking about what required rate of return on stock you're gonna get, you first start with, you're at least gonna get the risk-free rate, at least, okay? Yeah, go ahead.
Would that essentially be the market rate?
Well,
Because
market, when you talk about market rates, you're talking about market rates for bonds of corporations, you're talking about market rates for stocks of equal risk. But the risk-free rate is something different. Risk-free rate is the most safe government security that you can secure. So it's the safest, so you expect the lowest rate of return. So risk-free rate is the rate of return on a treasury security, and for that, think about that's the floor, the lowest amount you're willing to accept as rate of return. Now to that amount, you're gonna add in something called the market risk premium. The market risk premium is basically the additional risk you are now taking above and beyond the risk-free rate. Okay, so if you bought stock in a corporation, would you want a higher rate or lower rate than a riskless treasury security? Higher. That higher, that incremental amount above the risk-free rate is your market risk premium.
Okay.
Does that make sense?
Yes.
So now you have your market risk premium. Now to that, you want to also factor in what amount of risk that specific stock adds to your portfolio. Okay, so some stocks are risk. Remember we talking about diversification? Some stocks add more risk to your portfolio even when it's well diversified. That additional risk that brings even a well diversified portfolio is called your beta. Okay, so when you talk about what rate of return you expect to earn on a specific stock, you have to consider the risk-free rate because that is the floor, the least amount you're willing to accept as a rate of return. Okay? Then you want to take the additional rate of return because it's a stock. So that would be a market risk premium. And then you also want to consider what additional risk that stock brings to your portfolio, which is the beta. So you put those all into this formula, so the required return on that specific stock is equal to the risk-free rate plus the market risk premium, which is the additional risk, times the beta, which is the risk that stock adds to your portfolio. So you put that all into a formula and it shoots out a required return on stock. So just look at the factors here. RS is the cost of the common stock, right? That's the rate they expect on the stock. The risk-free rate, RF, again, that's the lowest rate that you can earn because it's the safest security, it's a treasury security. RM minus RF, which is the market rate minus the risk-free rate, which I mentioned is the additional return that you expect because you're investing in stock and not the risk-free security. That is your market risk premium. And then beta is the additional risk that that stock brings to a well-diversified portfolio. So you put this into a formula and you shoot out your required return on that common stock, okay? There's another one called the discounted cash flow, DCF. And you can do it to find the rate on that stock. You can look at the dividends over the current pricing plus a growth rate. So there's two formulas to derive an estimate of the cost of that stock. Okay, so there's the capital asset pricing model. Obviously, if you're doing capital asset pricing model, you need to know what the risk-free rate is, you need to know what the market risk premium is, and you need to know what beta is. Or you can do the discounted cash flow model to find the rate on that stock, which would be based off the dividends over the price of that stock plus a growth rate. So we're going to go through examples later on that. So the cost of using reinvested earnings. Again, if earnings are paid out as dividends, the shareholders can use that cash for any purpose they see fit. That can include personal consumption, they can go on a scuba diving trip, whatever they want. They can reinvest in the same company, they can buy more stock, right, in that company. Again, it doesn't have to be directly from the company, you can buy it from another stockholder, right? And then they can invest in another company and earn a rate there. So that's what they can do if they were to be issued dividends. However, they're not being issued dividends because the company's holding on to that profit and reinvesting it in the company, okay? So if a company reinvests, meaning they retain their earnings, then shareholders suffer what I described before as an opportunity cost, right? Because they lose the opportunity to use that cash that they wouldn't receive otherwise via a dividend for their own purposes. So, that said, reinvested earnings will have the same cost of capital as the projects they finance, okay? What I'm trying to say is, you're gonna have some form of cost of equity because they anticipate a greater return on that, on those reinvested earnings. Alright, so let's do, the calculations using the capital asset pricing model to derive the cost of equity. So remember I said you need to know the risk-free rate, right?
Mm-hmm.
You need to know the market risk premium, and you need to know beta, okay? Market risk premium is nothing more than the market rate on, market rate minus the risk-free rate. So in this problem, we're given the risk-free rate, we're given the market risk premium, and we're given beta. So let's plug those into the formula to derive the required return on the stock. So we have a risk-free rate of 5.6%. To that, we're gonna add the product of the market risk premium multiplied by the beta, and you get a total required rate on the stock of 12.8%. Okay? Now quickly, absolutely makes sense, right? You have a rate on the stock that's much higher than the risk-free rate, because obviously there's a lot more risk associated with corporation than there is with the US Treasury bond, right? So let's talk about some issues. Actually, any questions on the capital asset pricing model? Does that make sense? Conceptually, let's forget about the formula. Conceptually, does that make sense? The way you're deriving the required return on the common stock. So what is the risk-free rate? What does that serve as? It serves as a floor, right? It's like a benchmark of where you should at least receive because you could have invested in a riskless security earning this rate of return. Okay, so you have your floor. Now you say, okay, but I'm not investing in a US Treasury security. I'm investing in a common stock in a risky corporation. How do I add an additional rate to that risk-free rate? Well, you look at the market risk premium and you look at the beta. Beta is specific to the stock that you're purchasing. Again, beta means the additional risk that a stock brings to your portfolio. Basically, it's a measure of how the stock moves with the overall market. But just know it's a measurement specific to a corporation. And then market risk premium is basically the incremental rate that you expect to receive for not investing in a risky security. Okay? So you take your risk-free rate, and then you take the product of your market risk premium multiplied by the beta, and you derive your required return on stock. So issues in using capital asset pricing model. Most analysts use the rate on a long-term government bond as a riskless, as an estimate of the risk-free rate. Like I mentioned, no one is as secure as the government, right? If you're gonna invest money and you're worried about safety, you're more likely than not just to invest with the government because they don't default on their bond payments. Corporations default all the time. So corporations are the definition of a riskless security. So let's just understand. So Treasury bonds are essentially free of default risk. We use 10 to 20 years because, again, our objective is to estimate the cost of capital, which will be used to discount a company's free cash flow over the life of the company. Remember we looked at the formula in the beginning of class? We're taking the free cash flow of a company out into the future, and then we're discounting it by the weighted average cost of capital to derive the value of the company. So because you're talking about multiple years ahead, you want to use a long-term bond, 10 to 20 years.
Mm-hmm.
Okay? Again, that's going to factor into your weighted average cost of capital, right? All right, so just keep in mind, there's no such thing as a truly riskless asset in the U.S. economy, but it's as close as it gets U.S. Treasury security. Okay, so that's what we use to estimate a risk-free rate, U.S. Treasury bonds. Okay, so Sabrina, how do we derive a risk-free rate? What security can we look at to derive a risk-free rate? Would you look at stocks? Would you look at bonds?
Bonds?
From who?
From the government?
Very good. So that's it. So risk-free rate, again, they're derived from bonds issued by the government. And now, when we talk about the next part of the formula in the capital asset price model, now we have to consider the market risk premium. So most analysts use a rate of 3.5 to 6% for the market risk premium. And then for beta, there's different estimates, different ways. And honestly, beta is the hardest one to really gauge, but let's go into it. So in terms of estimating the market risk premium, we look at historical averages, right? We look at what experts have to say, and we look at forward-looking estimates on the expected market returns. So the different ways we can derive that. Then when it comes to beta, again, beta is a measurement of a stock's relevant risk, which is determined by the amount of risk that the stock contributes to a well-diversified portfolio. It is easier to gather historical information, make estimates, and that's the easiest way to do it for beta. So let's estimate the cost of equity, not using the capital asset pricing model, but by using the dividend growth model. Remember, there are two ways: capital asset pricing model and dividend growth model. Remember, we talked about here, right? Cover this. We look at that risk-free rate, we look at the market risk premium, we look at that beta. As long as we have those three components, we can calculate that required return on stock. The other way is the discounted cash flow, which is the dividend over the price of that stock plus a growth rate. Okay, so now let's go to that formula. We have a current dividend of $3.12. We have a current stock price of $50. And we have a constant dividend growth rate of 5.8%. So let's fill out that formula. Again, we're looking for the required return on the stock. We have dividend at period 1. How do you find dividend at period 1? I'm removing it, so we talk about this. So it's a constant growth dividend. If you don't have the dividend 1 year from now, but you have the dividend as a current year, how will you derive next year's dividend?
You do an estimate based on the rate.
On the growth rate.
On the growth,
Right?
yeah.
So the formula would be the current dividend, which is dividend at time 0, multiplied by what?
That multiplied by the current. We did it last week. I just
2 weeks ago, yeah. 1 plus a growth rate. Remember that? So you do dividend at time 0, multiply by 1 plus the growth rate to get next year's dividend, because you're assuming a constant growth dividend model. You can find easily the next year you just keep adding a growth to the dividend. So to find dividend at 1 year from now, which is at time 1, you just take the current dividend, multiply by 1 plus the growth rate over the current price of that stock plus the growth rate. So you fill that out, you have a current dividend of $3.12 given in the problem, right? You have a price of $50. You have a constant dividend growth rate of 5.8%. So to get the next period's dividend, you would do 3.12 times 1 plus 5.8%, right? So you do 3.12 times 1.0858 over the current price of the stock, $50, plus the growth rate of 5.8%. So 6.6 plus 5.8% gets you 12.4%. Think about it. Wasn't that pretty darn close to the capital asset pricing model? See? Isn't that crazy how it works out? 12.8%, right? So just to show you, like, this is not bullshit with the way they're talking about the different components. It's obviously been tested through a lot of theoretical practice. So again, you put this in the formula, you get 12.4 is very close to 12.8 calculated with the capital asset pricing model. So when you see the consistency, right?
yeah.
So whatever approach you take, you're gonna get pretty darn close to the estimate of the cost of equity. All right, so estimating the growth rate, that's what we need to figure out, right? Because here we took the assumption that we know what the growth rate is, right? We know what next period's dividend is if we assume that the growth rate is correct, right? Because we know what the current period dividend is, and if we grow it by a growth rate that we know to be correct, then next year will be correct, the dividend. We know what the current price is, that's a given. So the only thing that's really up for subject is growth. So estimating the growth rate. We want to use historical growth rates if you believe the future will be like the past. You want to be very wary of that approach, but if you ever want to invest money. So You wanna obtain, analyst estimates, you wanna look at, Yahoo Finance, that's my favorite one, to look at, forward-looking estimates of growth rates. And then you can use the earnings retention model that we'll talk about next. So remember what the retention model was? We said it's the amount of money that what?
You said the earn of.
Retention, when a company retains money. Remember, if a corporation does not pay out a dividend, that means they're.
That goes into that doesn't help the people, it doesn't help the shareholders.
Doesn't help the shareholders in the sense that they're not
Gonna-
paying a cash dividends, but it could help them in the sense that the corporation is using those funds to reinvest in itself and hopefully generate a return even better than what the shareholders will receive. So we're gonna use the earnings retention model to figure out that growth rate, because that was the purpose of not giving out a dividend, right? Wasn't it to invest in the corporation itself and grow? So now let's estimate the growth rate based off the earnings retention model. So estimating the growth rate with the earnings retention model is composed of this. So you suppose that a company, in this example, has been earning 15% on its equity, okay, on its current equity, and has been paying out 62% of its earnings, okay? If the situation is expected to continue, what is the expected future growth rate? All right, so let's look at it from a formula perspective. Retention means what is not being paid out, right? So retention is going to equal to 1 minus the payout rate. They are saying that they have been paying out 62% of its earnings. So that means they've been retaining 38%, right? So we know that the retention rate is 38%, which is the same as 1 minus 62%, right? So we know what they're retaining. And we know what they've earned on their current equity. So whatever they're retaining, assume that it's going to be earning the same amount as its current equity, and that should give you your growth rate. Does that make sense?
Yeah.
Okay, so you're taking your retention amount, you're multiplying by the return that you currently have on your equity, and that's going to be the growth that you're having. Because think about it, you're adding to the pot that's earning that 15%, right, by retaining 38% of your earnings. So you're adding to the pot. So in this example, the growth rate will be 5.7%. And it's very, very close to the 5.8 that was given before, right? Here. So it just shows you that it was a good figure to use in your projection if you wanted to take this approach in estimating the retention models. Okay. Let me ask you a question. Could the constant dividend growth model be applied if G is not constant?
If the growth rate is not constant,
Yeah, can you apply the constant?
I don't think so. 'Cause that would
No,
sound.
You cannot, it's not
You cannot, but at some point, you will have a constant growth. Remember when we talked about the horizon value?
Yeah.
We said like the first 4 years, there are different dividends, payout, whatever the case may be, different interest rates. But at some point, you have to assume that it grows at a constant rate, and that's when you can finally use the formula.
You
to
cannot
figure out-
go.
Yeah, exactly. So, could the dividend growth approach be applied if G is not constant? Yes, non-constant growth stocks are expected to have a constant growth at some point. Generally, if you don't have it assumed early on, it'll be 5 to 10 years out. Okay, because no one's that good that they're gonna give you exact estimates, out 10 years. That's BS. They can give it to you for 1 to 3, 4 years, and then assume a constant growth rate, but you're never gonna get exact amounts going out that far. Okay? You can also use the own bond yield plus judgmental risk premium method. This is actually a method I think you guys will like a lot, because it's very simple. You are saying, I don't like doing math, I don't like using all these formulas, what's a good way to estimate what a required rate on a stock would be? So what do you think would be a very simple approach to applying? Remember we talked about the risk-free rate, or think of it like on a riskless security. That is the floor, the bottom amount you're willing to accept on the stock, obviously, because otherwise you could just invest in a risk-free rate. So you have a floor, okay? Think of that floor, right? That's the required return on debt, okay? Remember I said debt usually requires a lower rate than stock, because stock is more risky, right? So to calculate the rate on the stock, you look at the rate on debt. The rate on debt in the example, say 10%. and then you make a judgment call on what additional rate will be required based off the stock itself. Okay, so you would wanna look at expert analysis or whatever, they're like, you know what? Stock should have this amount of incremental of a rate above the return on debt. So that's called the judgmental risk premium. Do not confuse it with the capital asset pricing model's definition of equity risk premium, okay? It's not the same thing. So this method just takes the rate on debt and adds an increment for what you consider from your own judgment or someone else's judgment what the additional risk premium should be. So in this case, they're saying the additional risk premium should be 3.2%. You add that to a current debt rate of 10%. You're saying the required rate on stock should be 13.2%. Okay? So we talked about 3 different methods of calculating the rate on stock. We looked at capital asset pricing model. We looked at the discounted cash flow model with the dividends. And now we looked at the bond yield plus judgmental risk premium method. Okay? Compare all 3, they're all pretty darn close. So we use capital asset pricing model 12.8%, dividend growth 12.4, and the debt rate plus the judgment 13.2%. The average is 12.8. Look how close it comes. There's not a lot of deviation from any of the 3 methods. Probably the one that I would worry most about the assessment is this one, capital asset pricing model. Okay, so make sure you know that formula in and out. Again, the problem, if you're gonna calculate it, you need to know, you have to be given the market risk premium, you have to be given the beta, and you have to be given the, what else? What else? Market risk premium, risk-free rate, yes, very good. Okay, alright, so now let's talk about determining the weights for the weighted average cost of capital. As I mentioned before, if you have more debt than equity, obviously the rate of the weighted average cost of capital will be more geared towards what? The debt. And if the opposite holds true, it will be geared more towards the stock. So the weights are the percentages of the firm that will be financed by each component. Again, components are common stock, debt, preferred stock. If possible, use the target weights for the percentage of the firm that will be financed with the various types of capital. Alright, we need to realize that each firm has an optimal capital structure that maximizes the stock price. Any decent CFO will have a capital structure that's just in line with the target capital structure, okay? Therefore, a value maximizing firm must attempt to find its optimal or its target capital structure. Again, when you talk about capital structure, you're talking about how much is going to be debt, how much is going to be stock, how much is going to be preferred stock. So, value maximizing firms must attempt to find the optimal or target capital structure and then raise new capital in the manner that will keep the capital structure in line with the target or the optimal. So basically meaning you want to finance the company according to its optimal capital structure, okay? So let's just, for now, target weights, meaning your optimal capital structure. You want to have 30% weight towards debt, 10% weight towards preferred stock, and 60% weight towards common stock. Okay, that is the optimal structure that has been figured for a corporation. So, with that said, how would the corporation want to raise funds? In this ratio, right? If this is the optimal capital structure, you're raising funds, you want to make sure you're still hitting that target, okay? So, estimating the weights for the capital structure. If you don't know the targets, it's better to estimate the weights using current market values than current book values, okay? So, if you don't know the market value of debt, then you can use the book value of debt. Very little difference usually on debt. Okay, so look at this. So let's look at this, the weights of the capital structure of the company. So debt. It has debt that has a current market price of $1,153.72, and there are 70,000 bonds issued. So obviously you would multiply the 2 to get the total debt, right? Market value of debt is that current price of $1,153 multiplied by the 70,000 bonds, you get to a total debt of $80.76 million. Okay? When it comes to preferred stock, you have a preferred stock with a current market value of $116.95. You have 200,000 shares of preferred stock. So to get the market value of preferred stock, you multiply the current price by the number of shares, and you get to 23.9 million of market value of preferred stock. When it comes to common stock, you have a current stock price of $50, you have 3 million shares, you multiply the two, you get $150 million worth of market value in common stock. There's a typo here. It should be market value of common stock. Okay? So let's estimate the weights. We have debt with a market value of 81 million roughly. We have preferred stock with a weight of 23 million roughly, and common stock with 150 million. How do you get the allocations of your stack? How would you derive what percent is debt, what percent is preferred, what percent is common equity?
Maybe 10, 60%? Oh,
Well, but just off these numbers, let's say you don't know what the target is, you're trying to divide it. How would you do it? Would you just divide it? For debt, you would do 80.76 divided by 254.
oh,
You would do 23.3 divided by 254, and you would do 150 divided by 154. Obviously, you're dividing by the same number, your total percentages equal
100.
So estimate the weights, you took the market value of the debt, you took the market value of the preferred, you took the market value of the common, you divided each one by the total market value of all the capital structure. You get 32% roughly for the debt, 9% for preferred stock, and 59% for common equity. Look how close that actual was to the target. Very, very close. You see that? So they're doing a pretty decent job. They're raising it, the capital in a way that meets the optimal structure, which is target. So actual weights are close to target rates. Alright, so now this should be this is the easy part. This is simple math going forward. What is the weighted average cost of capital using the target weights? Target weights, I should say. So remember, weighted average cost of capital is the blended rate across all your capital. Your debt, your preferred stock, your common stock. So now we have to look at everything. Why do you think the debt has more to it than simply the rate times the weight?
Say again?
Why does debt, so look at the formula.
Yeah.
Weighted average cost of capital, first one in line is,
30%.
alright, what's your capital structure composed of?
is that
You
the
have,
interest you get back from it?
you have debt, you have preferred stock, you have common stock. So your debt is this part, right? Your preferred stock is this part, and your common stock is this part, okay? Common stock and preferred stock, they don't have any tax deductions associated with that interest. But like you said, that does. So you have to consider the tax savings you have from paying interest on debt. That's why a lot of companies like debt. You can deduct a good rate on the amount of interest you're paying on the debt. So the weight of debt was 30%, right? The rate on the debt was 10%. So you take the weight of that, but now you want to consider the tax savings. So you multiply that by 1 minus the tax rate of 25%. Okay? Then you look at it, your preferred stock. You look at the weight. It's 10% weight towards preferred stock, and preferred stock has a rate of 9%. Then you look at your common stock. You have a weight of 60%, and your rate on the stock is 12.8%. Each of these rates we calculated somewhere in the lecture.
Okay.
So you weigh it, but when it comes to debt, you factor in the tax deduction of it. So you weigh it, and you get to a weighted average cost of capital 10.83%. So if they ask you, what is your firm paying on all capital, now you know how to answer that. If you were quickly looking, you would just look at, oh, I know what my rate on stock is because I looked at the dividends. Oh, I know what my debt is because I'm paying this amount of interest rate, and I know I'm in this tax bracket, and I know I'm able to deduct some of it. And you can say overall, I'm paying 10.83% on the capital I raise as a firm. Again, that's the weighted rate across all your capital that you have raised for the firm. Okay? Again, and this makes sense because think about it. The lowest rate is on debt. We know that, right? Maybe not before tax, but definitely after tax, because you're saving 25% on 10%. So you're effectively paying what percent? 7.5%, right? So 7.5%, that is considered the lowest risk. 7.5% is less than the 9% on the preferred stock. Remember I said preferred stock is between debt and common stock. And then the highest rate is on common stock because these are the residual owners. They're not guaranteed a return. They don't have a legal document that says I need to get this amount of interest rate 2 times a year for 10 years. and I get my principal back. There's no agreement with that. With common stock, you are an owner, as if you opened up, think of it like a mom and pop. You're crossing your fingers that you do well, but there's no guarantee that things work out. So that's why the highest return belongs to the common stockholders, followed by the preferred stockholders, and then followed by the bondholders. That's why the 10.83 is higher than the after tax of the interest on the debt, right? And it's still gonna be lower than these, because obviously this is pushing the overall rate down. Does that make sense? Right? All right, so let's talk about what factors influence a company's weighted average cost of capital. So there are uncontrollable factors, such as overall market conditions, such as interest rates, right? We can't control that. Interest rates affect everybody, right? It affects, debt being issued, affects the return that you expect on stocks or whatever the case may be. The market risk premium and tax rates. Again, these are out of control. What we could control as a corporation, when they're talking about control, you're talking about managing the corporation, okay? The CFO cannot manage market conditions. They cannot manage the market risk premium. They cannot manage tax rates. What they could manage is how they raise capital. Hopefully they're competent and they're raising in the target or the optimal capital structure. They look at dividend policy. They're like, you know what? We can make more use of that money rather than issuing as a dividend. We can reinvest in the firm and grow it at a growth rate that will give you a value that's even greater than if you got it in dividends. Investment policy. Again, they can invest in riskier projects, which should yield a higher cost or a higher yield. Okay, so control factors are the capital structure policy, the dividend policy, and the investment policy. Okay, things you cannot control: taxes, market risk premium, and market conditions. All right. Is the firm's weighted average cost of capital correct for each of its divisions? So remember, the weighted average cost of capital pertains to the company as a whole. We didn't go into the different lines of business that a company has, right? A company can have a media business. For example, the company I work for, they have a share in the New York Mets, they have a share in the radio station, they have real estate. They don't earn the same rate across the board. It's different rates. So when you talk about weighted average cost of capital, it is different for the different divisions of that corporation, okay? So no, the composite weighted average cost of capital reflects the risk of an average project undertaken by the firm. Average project, in the firm level, right? Different divisions may have different risks. So you would need to calculate the division's weighted average cost of capital to be adjusted to reflect that division's risk and capital structure. All right, so again, weighted average cost of capital pertains to the company as a whole, so it can be used for an average project. But if you're talking about specific divisions with different levels of risk, then you have to make an adjustment and find the division's weighted average cost of capital to reflect the division's risk and capital structure. So the risk-adjusted divisional cost of capital, it's an estimate of the cost of capital a division would have if it were a standalone firm. It's almost like now you're trying to derive a new weighted average cost of capital for a division that's different than the whole firm as a whole. So this requires estimating the division's beta, cost of debt, and capital structure. Same way you would have computed it for the firm overall. Now you're focused on the division of the firm. Okay. So the way you can do it is pure play method for estimating beta for a divisional project. What you do is you find several publicly traded companies that focus only on that project's business. So in the example of the firm I work for, you have a media business, you have the New York Mets, you have real estate. If I wanted to focus what rate would be required for the New York Mets, where would I go? Go with Los Angeles Angels, right? Or go to the LA Dodgers. Look at their business. Look at their return. That's what you can anticipate for your line of business. So you would find several publicly traded companies that focus exclusively in that line of business that you're looking at, the division. You would use the average of the betas also as a proxy for the project's beta. Okay, sometimes it can be hard to find such companies, but you do your best. All right, we'll skip this. It's a different way of using accounting data where you should run regression analysis between the return on assets and the S&P index. All right, so let's look at division cost of capital. Again, we're using the capital asset pricing model. We know debt is 12%, risk-free rate is 5.6, tax rate is 25%, the beta for the division is 1.7, market risk premium is 6%. So we use that capital asset pricing model, right? Because we have our market risk premium, we have our beta, and we have our risk-free rate. So we plug those in, and we get to 15.8% for the required return on that division. All right?